Have you ever just stared at a stock chart and it feels like you're looking at a bunch of random, chaotic noise? I know I have. But what if I told you that hidden inside all that mess, there are patterns, signals that can give you a real edge? Well, today, we're going to decode one of my favorites.
So, take a look at this. You've got the price jumping up, dipping down. There's really no obvious rhyme or reason to it. This is the kind of chart that makes you want to just throw your hands up and guess, right? I mean, where is this thing going? What's the story?
It definitely looks chaotic. But what if there's actually a very clear structure here, just hiding in plain sight? A shape that tells us a story about the fight between the buyers and the sellers, and, more importantly, gives us a massive clue about who's about to win.
And boom, there it is. With just two simple lines, all that chaos just snaps into focus. This pattern is officially called a right-angled and descending broadening pattern. Yeah, it's a mouthful. That's why most traders just call it the descending megaphone. So let's break down exactly how you can spot this thing and what it's telling you.
All right, section 1. So how do you actually train your eyes to see this megaphone shape out in the wild? You know, it's actually way easier than it looks once you know the key ingredients to watch for.
The name really tells you everything you need to know. Just picture a megaphone, for yelling through, but it's lying on its side. And the key is it has a perfectly flat top. That top line is a horizontal ceiling the price keeps hitting, while the bottom line slopes downward, showing the price is making lower and lower lows.
And here's the simple playbook. First, you're looking for at least two peaks that hit roughly the same high price. You connect those with a flat line, and boom, that's your resistance. Think of it like a price ceiling the stock just can't seem to break through. Next, you find at least two bottoms, but with these, each new one is lower than the last. You connect those, and that gives you your downward sloping support line, a falling price floor. Put them together, and you've just drawn the megaphone. Easy as that.
Okay, so you found one. That's awesome. But the real million-dollar question is, what now? What is it telling you? Where is the price likely to go next? And this all comes down to what we call the breakout.
Now, the pattern can break in one of two directions. See, these megaphones usually show up after prices have already been rising for a while. So if the price finally closes above that flat top line, we call that an upward breakout. This is a big deal because it usually acts as a continuation signal, basically saying the original uptrend is back on. But if the price closes below that sloping bottom line, that's a downward breakout, and that's a reversal signal, a warning that the party's over and a new downtrend is probably starting. And you don't have to take my word for it. The data totally backs this up. The numbers show that upward breaks continue the old trend about twice as often as they reverse it. And downward breaks, they're even clearer. They are much, much more likely to be trend reversals. So you can see, the direction of that break is an incredibly powerful clue.
All right, let's get into the really good stuff. Let's get specific. Because, all patterns can fail sometimes, but the data gives us some amazing insights into when this pattern is at its most reliable. Let's crunch the numbers.
Okay, this right here is probably the most fascinating thing I learned. It's totally counterintuitive, right? You would think the chart patterns would work best when the market is strong and bullish. But this descending megaphone, it's actually more reliable. It fails way less often in a bear market, when everything else feels like it's falling apart. So to really put this into perspective, let's ask a question. Imagine the market is doing great. It's a bull market. You spot this megaphone pattern and you see an upward breakout. What are the chances it's a fake out? What are the odds it's going to fail?
The answer is 19%. This is what the source material calls the break-even failure rate. It's just a fancy way of measuring fakeouts. So it means in a good market, almost 1 out of every 5 of these upper breakouts just doesn't work out. That's a pretty big risk. But just watch what happens when we change the market condition.
And this slide lays it all out. It's the whole story. Look at the left side. In a bull market, that upward breakout failure rate is 19%. Now look to the right. In a bear market, that rate just plummets to 6%. And it's the same story for downward breakouts. They go from a 14% failure rate all the way down to a tiny 4%. The message here is crystal clear. This pattern signals are 3 to 4 times more reliable when the broader market is weak. How cool is that?
But wait, there's more. There's one more layer we can add to our analysis to get an even better read on the situation. A secret clue, if you will, that can help confirm what the price is telling us. And that clue is trading volume.
So as the price swings get wider and wider inside that megaphone shape, the trading volume usually starts to trend upward too. A lot of the time, if you kind of trace the tops of the volume bars, it makes a dome-like shape. But there's a special variation you want to look for that's a huge tell for a successful upward breakout.
Just look at this comparison. For a really powerful move up, that U-shaped volume trend you see on the left is exactly what you want to see. This shape tells a story. The high volume at the start shows that initial fight. The dip in the middle suggests the sellers are kind of giving up. And then that final rise in volume, that's the buyers stepping back in with force, ready to fuel that breakout.
So, let's just boil it down to one simple takeaway. If you spot a descending megaphone and you're thinking it might pop to the upside, glance down at the volume. If you see that distinct U-shape forming, the data says you've got a much better reason to be confident.
So let's tie this all together in a nice little bow. First, you spot the shape, that megaphone with the flat top and the sloping bottom. Second, you read the signal. An upward break means continuation, a downward break means reversal. Third, you check the odds. Remember, this pattern is happiest, it's most reliable in a bear market. And finally, you look for the clue. That U-shaped volume pattern gives you that extra confirmation for a powerful move up.
And there you have it. What looked like total chaos just a few minutes ago now has structure, it has meaning, and it has probabilities behind it. So with this powerful tool in your back pocket, the next time you see that megaphone taking shape, which clue are you going to look for first? The overall market trend or that little telltale U-shape in the volume?